Welcome to Yellow Brick Road Enterprise. This is Kenji Godfrey, and today I'm going to talk about long-term investing and short-term investing. Over the past couple months, there's been this big rave on like Bitcoin and Reddit and very quick, fast money, right? So, which is fine. I mean, there's a time and place to get that quick money grab and to be on your way. But your overall game plan should not be the quick one and done scenario because over time that's not going to be sufficient. And when you plan that short term game, it's a very fine line between investing and gambling. It's the same scenario. You put your money in, looking for a quick flip. But when you do that, it could be very volatile and you can actually lose what you gained. So you should be trying to, first and foremost, your foundation should be the long term play on investing. Whatever it is, stocks, I'm not going to say bonds, but it could be bonds, real estate, you know, Bitcoin, whatever you want should be a long term play. Bitcoin, new things that are in, you shouldn't be investing no more than like 10% of your money into those things in the beginning because you don't want to lose your shirt because you're not in a position to take that type of risk, right? You should only be investing about 10 to 15% of your net worth into investing, right? So that if something happens, you're not all out, right? But that's another video. So when you do the long term, it allows you to create generational wealth or long term stability when you play the long game. Perfect scenario. Let's just take this one scenario of buying a bottle of Coke, right? If you go buy a bottle of Coke at your local 7-Eleven, Wawa, Quick Check, Bodega, that 20 ounce is going to cost you roughly $2. Next time you go to one, look at the price. It's about $2. And you pay $2 for what? Convenience. And that convenience is instant gratification, right? You buy a 20-ounce Coke, you drink it, you're feeling good, right? Now, let's just say if you were to get in your car, drive down to your local supermarket, go down the aisle, pick up a 2-liter bottle of Coke, walk, go to the checkout, check out, guess how much that 2-liter bottle of Coke costs? The same price, $2. But because you walked or drove to the store, went down the aisle, got into the self checkout, then got in your car and went home, you receive 2 liters instead of 20 ounces. You want to know why? Because you played the long game. You went further. You didn't go for convenience. You went longer, so you got a better reward. Same taste now. The product is the same. It's the same exact taste, but you got more in one than you got in the other. And that's because what? You played the long game. Right? See? So when you invest, you need to have that same thing, that same mentality when you go in and you're investing. You want to play the long game. Okay? It's going to give you more return on your investment because of compound interest. People are going to ask me, okay, so what are you supposed to invest in? If you don't know too much about investing, your best bet is to go with the index fund, meaning you invest in the Dow Jones or an S&P, right? Just park your money in one of them. Vanguard got some of the best ones on the market. You can go in there and get your mutual fund, and you can start out that way. If you want to, get into, regular stock investing, the best way to invest when you don't know is to invest with your eyes. Your eyes don't lie. So if you see a bunch of people, they wear Nikes, right? They've been wearing Nikes forever. Buy stock in Nike. If you see people using Square and everybody's using it, you go online and you buy stock in Square. You see during the pandemic, people are using Amazon. What do? You go out and you buy stock on Amazon. So you invest with your eyes. Whatever you see people using on a consistent basis, you know that these products are going to be around for long periods of time. So that means the stock is going to pay out. Plus these big stocks, even if the actual value doesn't increase over time, they pay a dividend. Sometimes 2, 3, 4% on the dividend. So you make money on the dividend and the stock price. I don't want to go too deep in it, but this is going to give you a foundation, right? So with that, if you're getting dividends every quarter, if the stock price is being valued and it's going up and people are using it over long term, you'll make more money than instead of you doing short term. It's going to be very volatile. Like I said, it's like gambling. You going for the hit, everybody on it, it crash all of a sudden, like Bitcoin did drop down, you lose your shirt because you playing the short game and there's no backing of it, right? At least if you buy stock, if it goes down, you still own the stock. So it has the potential of going back up. So that's what you want to play. I'm not saying don't do it. Trust me, I'm not saying don't do it. What I am saying is be strategic on how you invest and invest long term first. When you get your money up, then you can go in there and pick and pop into different sectors in order to get to take advantage of things that's hot right now. But don't go for what's hot right now when you ain't got no long term gain. Right? That's always the best play. Okay? That's all for today. And guess what? I will see you on the next video. God bless and take care.